Good morning, everyone. This is Stuart. We're recording this early Monday morning. We wanted to get this update out to you in light of all the market moving activity. Quick summary of the discussion. We'll discuss tariffs, the S&P 500 and broader market sell-off and valuations, and then most importantly, assessing our risk tolerance and liquidity needs, as well as any opportunities that may be arising in this sell-off. Really quickly, disclosure, investing involves risk and past performance is no guarantee of future results. Liberation Day earlier this week on the 2nd was a shock to the market. Many had been expecting the administration to announce fairly high tariff levels ranging from 10 to 15%. What was not expected was the formula that the Trump administration used to calculate tariffs, which resulted in tariff rates ranging from 20% to 34% for China and more on many of our largest trading partners. If everything goes forward as planned, the tariff levels would be the highest since the 1930s, ranging from estimates of low to mid 20%. Importantly, our job is not to opine on the wisdom of this plan. It's just to help our investors figure out how to manage through this. The S&P 500 is down about 17.5% since its February highs. The NASDAQ has had a drawdown of 21% since its February highs. The futures market is pointing to further losses as of right now, with the S&P futures down about 3.8% and the NASDAQ down 4.75%. In Asia, trading has been ugly. The Nikkei in Japan down 7%, the Hang Seng Index down 10.5%. The forward valuation multiple on the S&P has corrected now from 25 times forward earnings to about 19. Want to show a longer term chart here to give some perspective on where the S&P 500 has bottomed out in prior sell-offs. If we go back in 2001, when we had the tech bubble pop, we got down to about 15 times forward earnings. In 2008, 2009, in the global financial crisis, about 11 times forward earnings. And then the prior two large sell-offs in 2018 and 2020, the market troughed around 16 times forward earnings. The risk to the market right now is both from a multiple standpoint, if we contract from 19 times forward earnings to 15 or 16, and from an index earnings standpoint. Right now, EPS estimates on the S&P 500 stand at about $268 per share for 2025. If we were to face a downturn, conservatively assume 10 to 15% decline in that earnings number, that would get you to about 235 to 245 in EPS. Combine that with the multiple compression, and I'd say that a very pessimistic case scenario could see the market down 20 to 25% from these levels. Right now, the Federal Reserve is not as concerned about the economic risks as they are about inflation risks. That might change. Bonds are getting a bid, but it's not that major. The 10-year yield at about 393 is back to where it was 6 months ago. That would help the government in refinancing debt. Importantly, corporate credit spreads are widening out, and corporate borrowers are not necessarily in a better position right now. Most importantly, how to manage through this. If you rely on your portfolio for near-term cash needs, we want to make sure that you have ample and stable liquidity. We're happy to talk to you about how to position for that. A sell-off is always a time to consider allocation changes that enhance the quality of your holdings. If there are weaker positions that you own, we're happy to talk through considering selling those if the outlook has deteriorated, and perhaps allocating to companies that have a more stable outlook. The honest answer, unfortunately, is that no one knows how these trade issues will evolve. We have to think through all scenarios. It's possible that this is all resolved quickly, and it's also possible that this is the environment that we have to live with for the foreseeable future. Markets tend to price in close to worst case scenarios when they're dealing with distress. So short of any resolution to the trade issues, I would expect the market to continue pricing in a deterioration in the economic outlook. If your investing horizon, however, is measured in years instead of days or months, and you have cash to employ, there are opportunities starting to arise. And we would suggest considering opening or increasing positions in firms for whom the risk is overly discounted. What do we look for? A strong competitive position, stable business operations, a strong balance sheet, meaning either net cash positive or very little debt, talented management team, and a realistic pathway to demand growth, even in this challenging environment. And lastly, a reasonable valuation. We think a number of companies are starting to overly discount the risks that they face, and there are interesting opportunities to deploy capital. Obviously, the risks are enhanced right now, and we would advise tranching into new positions. We're very happy to talk through what those might be, how they might fit through your portfolio, and to just help you manage through this current risk environment. If you have any questions, please feel free to reach out to us. We're there to help you manage through this, and we're happy to talk through any concerns you might have. Thank you, and hope you have a good start to the week.